Hi, my name's Joe Berko. I'm the CEO of Astor Realty Capital. We started a company about 7 years ago with the intention of bringing quality investment opportunities to our friends, our family. The concept was make sure that capital is preserved, make sure that the investments are yielding the highest possible return, and cycle capital back to the investors in a fairly short period of time. Today, we are participating in over 3.4 million square feet of ground-up constructions in various stages, from coming out of the ground to nearly fully completed, and of course, some pretty amazing exits. Our investors groups have grown. We are now institutionally backed with a partnership from overseas, a public company. We are focused on maintaining the quality, and will continue to maintain the quality of our investments, our transparency to our investors, and making sure that as a collective, we don't just have a bargaining power, but we're also controlling the destiny of where our capital goes and the sort of yield we're able to offer you. Hello, everyone. Thank you all for joining us. It's an exciting afternoon. I'm very happy to have you here. My name's Joe Berko. So without further ado, we have with us one of our dear friends that have joining us from Los Angeles at the moment. Ethan is very unique. He's been spoke about a lot, been written a lot about, have done some pretty amazing things in his career. One of them is his claim to fame as he formed together the CMBS commercial mortgage-backed security market back in his 30s. Ethan has also been named as one of the top 100 living legends in the world of real estate finance in the United States. And thank you very much for joining us this afternoon. How are you feeling? How is everything on the West Coast?
Thank you, Joe. Everything's great. It's good to be with you as always.
Before we go into what's going on in the economy, which keeps me up at night, we're looking into underwriting. Real estate is a conversation into the future. In the world of finance, you make a loan, expect to get paid in a year, in a couple of years' time. Things are changing quite differently. But before we go into that, I want to go into a little bit of the origin of the beginning of your career. So you've started in 1982. Can you share with me about the environment that you've started?
Well, it was a very, very, very bleak recession that I got out of college looking for a job into. And it's interesting you ask that, because this seems like we're about in a very similar place to that time right now. It's reminiscent of that early 1980s period. And I think we're about to have a hard recession, like that hard recession.
And so, without scaring the audience, we were looking at the time at some very heavy double-digit interest rate, double-digit inflation environment. And here you are, you're early 20s, you're at the saving loans. How do you even quote loans at the time? And where do you see the similarities?
Yeah, well, it's hard for anyone today to imagine that a 30-year fixed rate mortgage was quoted in the 13s and taken. That was normal. It was normal to go get a 30-year fixed rate mortgage and in a 13 handle on your coupon. And I'll never forget, Joe, which is just an early lesson in humility that I'll share with everyone here, because that's what life is all about, is really kind of coming to grips with your own, your own reality and your own limitations. But I was working, as you suggest, in the savings and loan industry. I was probably, maybe I was a year and a half out of college, but I was working in the mortgage industry, and technically I was a mortgage professional. And I'll never forget, a family friend was looking to get a mortgage, and rates had gone down such that fixed rate mortgages had gone down from the 13s to about 10%. And this individual said to me, do you think I should take an ARM, floating rate loan on my home, or should I lock in like a 10% fixed rate loan? And I said to him, don't be a pig. I mean, take the 10 while it's there. Because it had been in the 13s not that long before, right? Little did I know, of course, that would have been the high tick of all time going forward, right? And it was going from 10 straight down to, more recent times in the 2s and 3s. But, I look back at myself and laugh, which I think that's what the advantage of getting older, there are some advantages of getting older. And if you have a sense of humor, you can find humor in your own stupidity, looking back at your youth when you were so sure of yourself giving advice, so, but the mentality was, be happy with a 10, right? I mean, 10 looked good on fixed rate mortgage rates at that time. And the 1-year treasury was somewhere between 7 and 8%, 1-year treasury. Okay. So, it was a different interest rate environment, a completely different time. And, we're in a tough time right now. And I know you want to talk more about now, but reminiscent of then, I do think is the similarities are not necessarily in the absolute level of interest rates, because I don't necessarily think we're going to see 10s and 13s on the mortgage side, because the world won't be able to sustain that. But I do think we're going to see a hard recession, and we lived through a very hard recession in the early 1980s.
So we'll touch more about this because it wasn't that long ago, maybe 12 months ago, that like you said, interest rates everyone was taking loans in the 2% and the 3%, and the cap rates tend to follow, right? It looks like sort of like the way of the land. You buy a 3.25 cap, whether it is an industrial building in South Florida, or whether it is a multifamily in New York. You will be buying it at some sub 4% cap rate. Grab yourself some sort of an adjustable 3-year mortgage that will hover around those numbers and hope to stabilize at a 5. It seems that the 5% era is soon to be over, but we'll get there in a few moments. I do want to touch on a couple of other points of your career, and the reason I'm doing it, the reason we in the course do those things, is because market cycles are called that for a reason. They're cyclical, right? They'll come, they'll go. There's a lot of insight, there's a lot of learning material that we can pick up from those. And so during that time, there was a very interesting moment where also early in your career, you were at Morgan Stanley, you were doing a very unique transaction. There was a change of regulation at the time, and you were working on a $5.5 billion B piece that you were looking to sell. And they also came with a very important story and a big insight in that. Can we hear about that a little bit?
Well, I have a lot of stories. Again, that's part of also the good thing about getting older is you amass quite a few stories. That was a very interesting transaction in the sense that it was groundbreaking. There had senior subordinated structures had just been created in the 1980s, and no one had ever sold the subordinated pieces. And the savings and loan industry on the West Coast used that structure with the help of folks like myself on Wall Street to sell senior pieces that got investment grade AA ratings and were able to get good pricing on them. And they were keeping these B pieces on their balance sheets. And then the regulations about how they could account for those B pieces changed and forced them to liquidate those B pieces or face dissolution. I mean, they didn't have enough capital based on the way the regulators would view those B pieces. So all of a sudden they were forced to sell them. No one had ever sold a B piece. So until that time, the asset-backed securities and the mortgage-backed securities market was brand new, and the sale of a B piece or a junior piece had never occurred before. and there was no market for that. So I literally had to create a market out of thin air at a very difficult time, because the regulations that affected savings and loans were also, from an accounting standpoint, being imposed upon all other regulated financial institutions, banks, and insurance companies. So it eliminated the likely buyers. The only buyers that could buy at that time were non-regulated financial companies, and they were few and far between. So it was really a great experience in learning how to create demand when there really wasn't very much potential demand. And I got that deal done. I still to this day would say it was probably the most remarkable, surprising success that I might have had in my career, because the odds were stacked very heavily against us. And I learned a lot of lessons in that transaction, probably more than you want to hear me talk about right now, but it was an amazing transaction, and an eye opener for me in my career. And I think that maybe if I were to leave this thought with everybody here, is that you all go through your lives, we all do, and we all have those moments. And I think trying to harvest as much learning from our time, from our moments, is really the key, and I think that every day is an opportunity to learn. Every encounter, every transaction, some are more instructive than others, like that one, with a lot more lessons for us, but there are lessons every day if we choose to pay attention and take responsibility for our situations.
And so, with that experience, did that sort of like brought up the idea of creating the CMBS? Because essentially you are recognized as the orchestrator of the commercial mortgage-backed security.
Yeah, I mean, I created the market out of thin air, just like I created the market for B pieces that day out of thin air. So yeah, I would say, of course, that transaction that you referenced, which happened in about 1989, where I sold a large portfolio of B pieces that was in the hands of one savings and loan that was weak and needed to sell them, otherwise they would have gone under. I created a market for those B pieces that didn't exist before. It emboldened me, of course, later in life, to believe in myself and believe in my ability to create something out of nothing, to create demand and to create a market where none had existed, in order to solve problems. And so if you fast forward from 1989 to 1992, in 1992, the US real estate market had no lenders. And it's hard to even imagine, although it's becoming perhaps a little easier to imagine today than it would have been 6 months ago. But in 1992, 1991, all lenders had abandoned the market. And so you couldn't even refi your loans. Like, your own lender would say, yeah, your loan's coming due. Maybe we'll give you a 1-year extension because we know nobody is out there, but we don't want to be on this loan either. So get us off this loan. And in the face of that unbelievable stress, I saw that the securitization process that had been applied by myself and others on Wall Street to mortgage-backed securities on the single-family side could be applied to solve this problem for borrowers and owners of real estate that were facing existential risks. I mean, they were all facing going out of business risks because there was no debt capital. And this industry depends on debt capital more than any other industry in the world. So yeah, that was a great opportunity for me in 1989 to prepare me for what I was later able to do in 1992.
It wasn't that long ago that we've seen a similar situation. I remember the week and the days following the Lehman Brothers filing for bankruptcy. Simply all lending activity stopped. You couldn't get a lender on the phone. It was actually surreal. I remember we were.
It could be, I mean, I don't want to, again, play the doomsday card here, but what I think everyone here has to understand, everyone here is real estate focused. but money doesn't differentiate between opportunity, right? There's something called relative value, and everything has to fall in line with relative value. So, you know, you can look at inside of the real estate industry, and you can say that that beautiful apartment building that was being valued, and you have an appraisal to show for it 6 months ago at a 3 cap or a 3.5 cap. You say, well, what the hell's changed? I mean, it's still a beautiful apartment building. It's still in a beautiful neighborhood, and people still want to live there. The problem is that when people with money look at that beautiful apartment building, either to lend on it or to buy it, they have other things that they could do with their money. And if those other things that they could do with their money are yielding significantly higher than the leverage yield projected on that 3 cap, then that thing doesn't get a 3 cap anymore because it's competing in the world of other financial assets. It's not competing in the world of real estate. And I think that's a very important thing. Relative value. I grew up on a trading desk at Drexel and then at Morgan Stanley. And I learned firsthand how everything is competing with everything for capital. And that's why everything affects everything. The price of everything affects everything. And I think the real estate industry tends to encourage very insular orientation. People in the real estate industry tend to look at real estate. They don't realize perhaps that real estate competes with everything else for investors' dollars and therefore has to offer a yield that's commensurate with what's available elsewhere. And that's why today, real estate's not worth what it was 6 months ago. And it's not even close. It's absolutely not even close.
And I want to talk about that because we are seeing shift, and it's actually very, very concerning shift, and they're very quick. I do feel
not as quick as the stock market or Bitcoin or other things. You can look on. You could look right on your computer screen and see that's real quick. But real estate is a private market for the most part, although REITs are not. And so REITs, you see it more, right? REITs are down, whatever they're down, 25%, 30% with the rest of the market. And I laugh when I hear people that invest in private real estate, and they go, well, that's why I don't want to invest in REITs because REITs are down 25%, but my real estate's not down anything. I said, dude, your real estate's down 25% too. You just don't have a mark to market on it, right? And if you try to sell it, you'd find out pretty quickly what it's really worth.
So market dislocation, you have a really interesting quote that I love. The rules of investing in market dislocations are the same. In normal markets, they are the same, but the price of violations of those rules in dislocation market are much higher. So what do we mean by that? And how do we apply it for today's conditions? And looking a little bit out, 1 year, 18 months, what would you look for? What would you stay away from? Where are the red flags?
Well, I think that the red flags are probably twofold. One is don't have staying power, right? So buying things that are good. So that, I guess maybe I'll start with that. Buy things that are good. Don't buy things that are not good. And in real estate, probably today, maybe more than any recent time, but I think this has been true for a while. I think that most people in real estate tend to be backwards looking, and they're the last to see societal trends. But I think that if you looked at societal trends that have been in place for the last decade or more, obsolescence in real estate should have been obvious to everybody, right? Whether it's the Amazon effect on retail, or whether it's tastes that have changed with regards to where younger generations want to live versus where older generations want to live, or whether it's understanding how people want to spend time at work in the office, and what does that mean for the physical structure of the office and the location as well. So there's a lot of obsolescence risk in real estate today. And I guess I would say that when looking for opportunities, don't buy something that is down 50% on its way to being down 100%. Okay. And
Absolutely.
there's probably a fair amount of that out there. Uh, and then when you buy the things that are down 50% that are likely to rebound to be worth 100 or even more than 100% someday, someday is the operative word. You don't know whether that's going to be 6 months from now or 6 years from now, and nobody knows. And so having staying power is very, very important. Of course, leverage cuts both ways. So if you have too much leverage and short-term leverage, and you bet right, and the turnaround is short in nature, you're going to make a lot more money than someone who under leveraged. But if it turns out that the turnaround is not as fast, you'll have lost all your money, and the under leveraged person will have done just fine. So you have to know what you're doing and just have your eyes open.
So you're making mortgage bets on a daily basis. What would you consider as a very high risk bet? Can I put in that basket office building in certain cities? Can I put in that basket hotels in certain locations? And
I mean, what do I think is what I call viable real estate? Like,
mhm.
I think that one of the most enticing things about the real estate industry is that there's no such thing as the real estate industry. So for when I say that, I mean that a hotel in Times Square, New York, literally has nothing to do with an apartment building in San Antonio, Texas, which in turn has nothing to do with an office building in Calabasas, California. So when we think about the real estate market, not those three, and pretty much you could say that for most real estate, they don't relate to each other. The only thing that is common about them is that they're competing in the market for money, and they have to trade at a yield that makes sense in the capital markets when competing in the market for money. That's the only thing they have in common. Other than that, they have nothing in common.
And so when you're making bets, when you're given a loan, would you lend today on an office building in New York City? Would you lend today at a hotel in Hollywood?
Well, first of all, let me address let me rephrase the question a bit, because I want to dispossess everyone of the notion that lending is something different than buying. Okay. It's not. It's the same, it's the same decision in a different part of the capital structure. I'm a person who wants to be in the best part of the capital stack, the most rewarding on a risk adjusted basis. That's all I want to do. Sometimes that's the first mortgage to a 50% loan to cost. Sometimes that's in the equity in the first loss position, right? So I like to say, if someone comes to me looking for money on their deal, and they're going to buy something or build something for $100, and their plan is to turn the $100 into $200, and I like their plan and I believe they're going to do that, the last thing I want to do is be the schmuck who gives them $60 and gets 6%, and then they turn $40 into $140 and I feel like an idiot, right? I want to be in the $100 place, and I want to participate in the $100 profit. On the other hand, if someone comes to me with that deal and I look closely at it and I say, well, they're going to be lucky to turn their $100 into 105, well, then I might want to be in the $60 or $70 position and collect a really good return and be safe. So I'm agnostic about where, whether equity or debt or mezz or pref is better or worse. It just depends on the deal. Now, if you were to say to me with that way of thinking, would I be interested in looking at an office building in New York City? I guess I would say I've not been a big fan of New York City for quite some time, as I probably would think, knowing you have not either. I'm a big believer that politics is an underappreciated contributor to value degradation as well as value creation. And I think the politics of certain cities, New York being one of them, has been generally, I think, hard and unattractive to participate in, and unpredictable as it pertains to impact on value and negative. So I've avoided New York for quite some time. The last deal I did in New York, which was a very, very small deal, was in 2013, and I haven't done anything in New York since. San Francisco the same, Chicago the same. These are just cities that have pursued political policies that are, to me, anathema to a healthy society, right? I think that if you don't prosecute crime, and that leads to a fear for safety for its citizens, that's not a healthy environment to be in, and probably not going to be a growth area economically. So I've avoided those situations for those reasons, and New York's one of them. So I probably would not be interested. It's a long way of saying I probably would not be interested in looking at anything in New York, including an office building. But I would be in the hierarchy of what I would be least interested in. I would be least interested in older office buildings in tired locations. I think that that's an invitation to lose all your money on any part of the capital stack.
Mm-hmm. And we've seen it. We've seen it happening. We've seen it happening. It's quite shocking. Some of the largest players have handed back the keys recently for office buildings in New York City, and if you go and you start thinking about it, it actually starts making sense. It's those big giant office building with tremendous large floor plates, 60,000 square feet, 40,000 square feet floor plates are almost obsolete. There is no way to convert it to an apartment building. It's just too much space. There is no way to convert it to a hotel. So, the future of those, it's still up in the air. Let's move into more of a lighter environment. The multifamily is, I've seen leaps and bounds like we've never seen in probably forever. We're talking about $63 billion spent Q1 of 2022 in terms of sales, trading hands, $374 billion in multifamily throughout the United States. Cap rates are compressed, 4.6%. We spoke about it earlier. 3 caps, 2 caps, no caps is kind of like the way of the land. From 150 major markets throughout the United States, 129 of which reports tremendous increase. Florida is taking the cake over here with some pretty large increases year over year in rents. We're seeing the big displacement of individuals. A lot of capital is moving to different states. This is all good when your yield treasuries is around 150 basis points. Now we're talking about 350 basis points. Where is, in your opinion, a Class A multifamily going to trade going forward in the next 12 months if the environment will continue pushing the treasuries up to the 400 basis points, and maybe even north of that?
I would say that I'm going to answer that question a little differently. I think, I don't know if someone, it might have been you, said, I answer whatever questions I want to answer. So I'm going to twist your question a little bit. You said this, but I won't answer Class A because I'm not. I like Class B and I like Class C better than I like Class A. I always have, and I think it has to do with the fact that there are more tenants always looking for Class C and Class B apartments than there are supply of Class B and Class C apartments. And so I find that to be a very favorable place to be. Class A apartments are competing with housing, and there's a lot of variables that go into Class A that I find less appealing as an investment. So I generally avoid Class A apartments. So I'm going to answer your question for Class B and Class C. I think Class B and Class C apartments are the best by far. I don't even know what I would say is the second best, but it's by far the best of the asset classes to invest in the United States real estate market, and maybe even outside of the United States real estate market. I think that there's pricing power on rents because of the reason I mentioned. The supply demand imbalance is unbelievable, right? The need for that product relative to what exists and what is being built it's multiples. I don't know if it's 10 to 1 or even more, but it's gigantic. And the only limit you have on pricing power with regards to raising rents is that unfortunately in today's economy, people are strapped, right? Food and energy costs have doubled. So there's very little money left over in any family's budget, working class family's budget, or even, more affluent than working class. And I think that that'll put a lid on rental growth for a little while, right? But in the long run, if you go past the next couple of years and you can see that this economy will give way to a different economy and a different reality with different pricing for food and energy than we're seeing today, then you can see rental growth because of the supply demand imbalance come back in for the class B and class C apartments. And I think that's the best place to be. What kind of pricing do I think makes sense? I think that you can reasonably underwrite to a cap rate that is somewhere in the 5-year treasury plus 100 basis points and be pretty comfortable that you're going to do pretty well at that point. That's how I would look at it. So if 5-year treasuries are in the neighborhood of, I don't know where they are, 3, give or take a little, 4 cap seems like the right place to be today, given the future that I think is very, very favorable. And I think that, but again, there are caveats because it's real estate. So are you in a location that is going to be good 5 years from now and safe 5 years from now, where people want to live 5 years from now? Are you in a building that's falling apart, right? I mean, you remember that one in Miami that literally collapsed and people died.
Horrible.
Or yeah, and there's a lot of obsolescence like that that's just
Right.
that's there. So there are caveats, right? But if you're in a decent building that's structurally sound, in a location that's reasonable, safe for working class families to live, today a 4 cap portfolio, and I think you probably get it cheaper than that. So I think that's a good place to be.
It's interesting. I want to challenge your point. I want to ask you this. A couple of weeks ago, we've had an analyst from one of the life companies, the largest life companies in the United States, who had a very interesting take on what she said. And I want to hear your thought about that. What she said was, you know what, we want to be in the Class C, because Class C essentially is kind of like, I wouldn't call it last resort, but certainly very affordable. And you also tend to see government such as Section 8 and all kind of different programs are out there to pay those rents. We also want to be in the Class A because when it's tougher out there, people tend to buy less homes, certainly with a high interest rate environment. And so the Class A's will tend to maintain value, and those who have what it takes will continue paying even through some sort of a turmoil. Class B's, on the other hand, according to her, and it was an interesting point, are the most dangerous ones because you're sort of like not supported by any sort of program, governmental program or otherwise. You're not in the kind of like the higher brackets where Class A residents tend to congregate, and you're sort of like stuck in the middle, and usually the middle gets to get squashed. What do you think about that?
I disagree 100%, and I'll tell you why. It's a typically, and I'm sorry to say this, but it's a typically backwards looking perspective. The government has programs in place for the people at the bottom end of the socioeconomic status, Section 8 and other programs. And I guess that's what this particular analyst was referring to when they were saying Section C benefits from social or governmental programs, and saying that Section B, Class B, which is maybe a grade above that, doesn't. But here's the thing. I guess the residents of Class B apartments are the true working class, not the indigent non-working. Okay. And so whether that's nurses or or firefighters or policemen or teachers, my mom was a teacher. I lived in probably a Class B apartment. So these are people who may not have a social safety net as long as the economy is functioning. But God forbid the economy stops functioning and these people need a social safety net. The government will create social programs for them because they can't let these people become homeless. Like, you know, even though Class B sounds like it's a big cut above Class C, it's like a paper thin cut above Class C. You know, like I might say my mom was a teacher and we lived in a Class B apartment. My mom had, I don't think she had $1 in her savings account and she didn't have any stocks or bonds. So we lived in a Class B apartment, but we were poor, you know what I mean? And I think we were working class, you know, we lived paycheck to paycheck. And I think that's what Class B residents tend to their profile, right? In today's world, I don't know, I don't remember the number, Joe, but I think it's well over 50%. And it may be approaching 70% of American families live paycheck to paycheck. So it's not just Class C. It's not just Class C that's hanging on by their thumbnails. Okay, it's Class B too, and just because they don't need help today doesn't mean they may not need help in the future. And when they do, as for example, they needed at COVID, money printing and programs were created immediately that were there to help them.
I just want to say this, it was fun to be a seller of a Class C apartment building 6 months ago, 9 months ago, because I think the market was insane. We enjoyed reaping the benefits. We don't have much time. I want to ask you a couple more questions. What's keeping you out at night as it relates to business, as it relates to the economy?
I think that we're not, you know, most of the market participants today have little experience with down markets, with bear markets. I think that, I also think that the government, including the Fed, doesn't have an appreciation for how fragile our economy is. And so I understand the inclination to stave off inflation by raising interest rates as they've done, by shrinking the Fed balance sheet, which is another form of monetary tightening. But I'm afraid that they're doing it aggressively in a time when our economy is very, very fragile. And you know, how far we fall before they wake up and realize that, that's going to be an interesting thing to watch. I do believe, Joe, that the tough Fed that we're seeing today will become the accommodating Fed very, very quickly, probably much more quickly than people imagine, because I do think the numbers are going to turn bad pretty fast. So, you know, the stock market has lost $12 trillion as of last week this year. That's 4 trillion or 50% more than was lost at the worst day of 2008. That's kind of an amazing amount of wealth to just disappear from our country. And the ripple effect of that disappeared wealth, it will hit everything. And it will happen fast. And when it happens, the Fed's going to be reversing policy quite quickly. And well, I hope that it'll work out just fine, but it's going to be an exciting moment. So if I lose sleep or worry about that, I worry about that.
And so perhaps the after effect of a very quick climb in interest rate will be sort of like a slow and steady a dive back into something manageable.
I don't think slow and steady, Joe. I think we're going to have a 0% interest rate policy within the next 12 months.
Okay, that's more of this.
Yes, it was like, whoops,
Woo-hoo.
it'd be a big whoop.
We gotta brace ourselves. Final questions. I know you have to leave. You told me once that you start your day looking at the global economy. You read the articles, you read the news about the global economy, then you start looking at the US economy, you start looking more granularly at where it is that you're operating. What's your view of the global economy?
Well, I think it's very fragile. I mean, I think that what I said just now about America, I feel is true about most of the world. I think the world's in a very, very precarious spot. I think that there are a lot of things to be very concerned about. I think that our ability to withstand the loss of the trillions of dollars that we've experienced just in America alone, let alone in other countries, is uh, it's going to be tested, and our resilience will be tested. And I think we're going to fail the test. I think it's going to be a very unpleasant period, and that's why I think that we're going to see Fed policies reversed very quickly to save us from a depression, just like what happened in 2008 and 2009. We would have had a depression far worse than 1920s if not for the Fed coming in with an extremely aggressive intervention. I think a similar intervention is absolutely coming soon.
Was challenged, by the way, by Milton Friedman, who wrote and was absolutely against the intervention of the Feds. He said, I think he felt the biggest mistake at the time
Yeah,
was the intervention of the Feds.
but I agree completely with him, except let me give you the analogy. Okay. Let's say you have somebody who has a first heart attack. Okay, they led a bad life. They ate fried foods too much. They didn't exercise at all, and they had some mild heart attack. Their heart is still strong enough to find a healthy lifestyle, to find exercise, to eat well, to get enough rest, they could their heart attack was mild enough that their future is not compromised. But perhaps someone who had a very severe heart attack and their heart is no longer, it's fragile, it's no longer able to go back to the young heart that can work out hard enough to get the benefits from working out and can no longer survive by itself. It needs permanent help, right? That people put stents in their heart, they take all kinds of medicine for the rest of their lives. And I think that's what the analogy for this. I think that Milton Friedman, if he were alive today, would say perhaps in 2008, our economy was strong enough, or in 2000 before that, our economy was strong enough to, and we were as a society strong enough to bounce back from a difficult period, no matter how difficult it was. I don't think he would say that today. I would say we are now a basket case, like, we need medicine.
Any final words before we part, Ethan?
Yeah, I guess I would say people look at the market today and the stock market, the real estate market, the financial markets, and they go like, my God, how did this happen? As though this was not obvious. Let me just say this was very obvious. It didn't take a genius to forecast that we would be in this place right now. When the Federal Reserve Bank says they're going to raise interest rates 8 times in the next year, they're telling you they're going to crush asset values. They're telling you that. I mean, couldn't be more. It's English, okay? They're using financial English. And what it shows me, and I've seen it over the course of my life, is that we are in denial. We tend to, we want happy talk. We don't want to just see what's obvious and take the necessary steps to protect ourselves. We'd rather just, have another cocktail or smoke another joint, as the case may be in today's society, and engage in happy talk. and ignore the bad signs, but they were there. I mean, it wasn't even, it was obvious. And I think that there's a lot of things that we can say that about in our society today. I think we are intentionally blinded, and we put blinders on ourselves, and we, up is down and down is up. And, you know, we can say that. We could all agree to be polite with each other and say, up is down, Joe, but up's not down. Okay. And ultimately, gravity will teach you that lesson. So, lying to ourselves is never a good idea. And I think our society is engaged in a lot of that.
Thank you very much, Ethan. As always, it's a pleasure. Please come back and join us again. And blessings, everyone. It seems like we need to hold really strong. You know, tough times are ahead. Make good decisions about your investments and make good decisions about education. I hope I'll see you here again. Thank you, everyone. And feel free to reach our team with any questions. Take care, Ethan.
Thanks for having me, Joe.
Take care.